Hi, this is the third module of the Value Investing Bootcamp, in which we will cover the important topic of risk. When most people think about investing, they think it is like gambling and therefore risky. However, with gambling, the game is rigged and the house eventually wins. Also, with gambling you have to increase the risk of losing money in order to increase your potential profit. With value investing it is the other way around. You can actually shift the odds in your favor by minimizing downside risk while maximizing upside potential. But in order to avoid risky situations, we must first have a clear understanding of what risk actually is, because there are many painful misconceptions in this area. Let's see what they are. According to Warren Buffett, risk comes from not knowing what you're doing. Imagine a roulette table. You can bet on any color or number. The more precise you are, the higher the payout. So if you say the ball will land on 15 black, and it does, you earn a lot of money, else you lose it all. However, the odds of the ball actually landing on that particular number is 1 in 36. It is pure chance if you happen to be correct. It has nothing to do with your roulette skills. In other words, there is no fundamental reason why the number you chose is better than any other. You just have to be extremely lucky to win. Relying purely on luck is a dangerous strategy which can turn millionaires into poor men in no time. Don't fall into this trap, no matter how alluring the profits are that they promise you. In his bestseller, The Little Book That Beats the Market, fund manager Joe Greenblatt said, "Choosing individual stocks without any idea of what you're looking for is like running through a dynamite factory with a burning match. You may live, but you're still an idiot." Picking stocks without taking the fundamental performance data of the underlying company into account is like betting on a roulette table. In fact, this practice cannot even be called investing anymore. It is pure speculation. It is gambling. However, if you base your investment decisions on how profitable a company is and how cheap their stocks are, then you shift the odds in your favor and change the game completely. It is like you are counting cards in the casino, only this time it's legal and much easier. In his must-read article, The Super Investors of Graham and Doddsville, Warren Buffett said that risk-reward is not positively correlated for value investing. The power of this statement is profound, because what Buffett says here goes straight against many financial theories taught in today's business schools, like the capital asset pricing model, which says that in order to earn more money, you need to take more risk. This is absolutely wrong, at least when it comes to value investing. In fact, more risk actually leads to lower returns, because you'll incur more losses, and we saw in an earlier lesson how hard it is to earn back losses. To illustrate, imagine someone walks up to you and asks you to buy $1 for just 50 cents, and another guy walks up to you and asks you to buy $1 for $1.50. Which option offers you the highest possible return if the dollar you buy rises to $2 in 1 year? That's right, the first option. The first option would earn you $1.50, while the second option would earn you just 50 cents. And which option offers you the most protection against downside risk if the dollar you buy declines to 75 cents? That's right, also option 1. Option 1 would still earn you 25 cents even though the price declined, while option 2 would have cost you 75 cents. So option 1 not only maximizes upside potential, but also minimizes downside risk at the same time. Take a few seconds to let this fact really sink in. Okay, that's long enough. So if investing is not like gambling, where does the risk come from? Well, as we saw in the previous example, the lower the price relative to value, the lower the risk and the higher the upside potential. Declining prices actually make stocks less risky as long as the fundamentals remain strong. So, to a large extent, your purchase price determines the risk you take, which is something many investors seem to overlook or underestimate. What else is risk? Well, many financial theories and complicated stock market formulas assume that volatility equals risk. In other words, a stock which swings up and down in price is more risky than a stock with a relatively stable price. But is this true? Not really. We discussed before that price says little about how well a company is performing. While the company's value steadily increases, its stock price might fluctuate wildly. Does this mean a company is risky to invest in? No. These price swings merely offer attractive opportunities to buy the stock when the price swings downward, and attractive selling opportunities when the price swings upward. Volatility is not risk. In fact, you should expect volatility and use it to your advantage. Volatility is also part of a common measure of risk, called beta, which is used by many stock analysts and portfolio managers. The beta of a stock measures how volatile a stock is relative to the overall market. But as we just learned, volatility is not risk, so beta is also something we can forget about entirely. This is what Warren Buffett had to say about this. Our investors, needless to say, do not discuss beta, the capital asset pricing model, or covariance in returns among securities. These are not subjects of any interest to them. In fact, most of them would have difficulty defining these terms. The investors simply focus on two variables, price and value. And so should you. But what about uncertainty? Does uncertainty about the future of a company equal risk? Again, the answer is no. You often see the stock price of companies which are being sued or investigated decline like crazy because people are uncertain about the outcome of the investigation. In cases like this, people often overreact. If a billion-dollar company is being sued and in the worst-case scenario they have to pay a fine of a couple $1,000,000, this is just a small bump on the road for them, nothing serious. And keep in mind, they might just win the lawsuit, in which case the price drop would have been even more unjustified. Of course, there are cases where the outcome of a lawsuit could mean the difference between extreme profitability if they win or bankruptcy if they lose. But more often than not, investors overreact to uncertainty. Therefore, uncertainty is your friend because it creates opportunities to buy temporarily distressed companies at bargain prices. The key word here is temporarily. If a company has fundamental, long-term problems, it should of course be avoided. Behavioral finance teaches us that in general, people are risk-averse, meaning they would rather have a certain small gain than an uncertain, much larger gain. People simply do not like uncertainty. This is a big reason why many people do not invest at all, and rather put their money in a savings account, where they earn only a tiny interest. They rather have a certain tiny interest rate from their savings account than an uncertain, much larger gain by investing their money in stocks. So if volatility is not risk, and if uncertainty is not risk, then what is risk? Well, the true definition of risk is a combination of the probability of a loss and the amount of money you could lose. It cannot be quantified exactly. Also, risk is a perception. For example, while uncertainty does not create more risk in itself, because it does not increase the probability or the amount of loss, it simply makes it harder to estimate the risk, and therefore it makes people feel like there is more risk. No matter how much research you perform, you can't possibly know everything. You have to act on imperfect information. There will always be uncertainty. And it is precisely because you can never know the true risk of an investment that you should aim to invest at a significant discount to intrinsic value. This discount offers you room for error and protects you from losing a lot of money when things go wrong. But before we start talking about minimizing risk in the next lesson, let's first summarize this one. Risk comes from not knowing what you're doing. Speculation is like gambling and is based purely on luck. Investing based on fundamental data shifts the odds in your favor. Risk-reward is not positively correlated for value investing, meaning that you can minimize risk while maximizing potential returns. To a large extent, your purchase price determines the risk you take. All other things being equal, the lower the price, the lower the risk. Volatility is not risk. In fact, you should expect volatility and use it to your advantage. Beta is not risk. You should not pay any attention to this metric, even though many financial models rely on it. Uncertainty is not risk. It merely makes it harder to estimate risk, which in turn makes people feel like there is more risk than there actually is. In fact, uncertainty is your friend, because most investors tend to overreact to uncertainty, because they are generally risk-averse, which creates attractive buying opportunities. Risk is a combination of the probability of a loss and the amount of money you might lose. Risk cannot be quantified. It is a perception. No matter how much research you perform, you can't possibly know everything and will have to act on imperfect information. Buying at a discount gives you room for error and lowers your chances of losing serious amounts of money. Now that you know how to think about risk, we will find out how we can minimize the risk of your portfolio in the next lesson. See you there.